The Committee on Pensions, Investments, and Financial Services will come to order. The clerk will call the roll.
Chair Capriglione.
Here.
Vice Chair Lambert.
Here.
Representative Bojani.
Here.
Representative Bryant.
Here.
Representative Frazier.
Here.
Representative Leo Wilson.
Here.
Representative Plisa.
Present.
Representative Van Dever. Representative Vo.
A quorum is present. As a reminder, anyone present wishing to testify before the committee, please register at the kiosk located in the hallways behind the hearing rooms. If you require assistance in registering or testifying, please contact the committee staff. Chair appreciates the cooperation of the committee and our visitors in preserving order and decorum during today's hearing. Members, as a reminder, we're in the middle of testimony on House Bill 3827, and we'll pick right back up where we left off. The chair calls on Vice Chair Lambert to continue. Oh, no, I apologize. We're in the middle of witnesses. So the chair calls Brianna Gordley with Texas Appleseed. We show you registered as Brianna Gordley on behalf of Texas Appleseed, and you are testifying against the bill. Is that correct?
Yes, thank you. Chairman, Vice Chair, committee members, me again. Thank you so much for allowing me to provide testimony on House Bill 3827. Our organization is opposing the bill. We've had multiple conversations with the Vice Chair's office, so they do understand what our concerns are about the bill. In Texas, we really want to see affordable options when it comes to Texans and the credit market. And I've already mentioned this, but because of the very unique structure of the payday lending market, Texans are already at a significant disadvantage when it comes to accessing credit, and so we want to see reasonable alternatives. And we heard from the gentleman from Daily Pay. The type of earned wage access company that he represents is an employer-based organization, and so there are two different types of models. We have employer-based, we have direct-to-consumer. Most of my testimony is going to revolve around direct-to-consumer. These are the apps that are not secured by your wages that any user can download today. You all could. I have been using one to see how these products really work, and you get essentially a cash advance. So there's a lot of different types of these products. I want to be very, very clear that there are ones that exist that are through your employer, that the agency does contract with the employer, and it's an actual payroll deduction. Most of these products are not that. So we see the potential benefit that earned wage access products can have if they're properly regulated. We want alternatives. We understand that in more rural areas, it's just really difficult for consumers to access credit, and we absolutely see the benefits of these products. But as they stand today, there are no regulations, and a lot of their practices are extremely concerning. There have been several class action lawsuits because of their unregulated practices, and we really don't want to enshrine these providers into law because of the concerns with their practices as they stand. So my testimony is quite detailed. One of our biggest concerns, and this may just be a fundamental difference that we do have with the author's office, is that we do see these products as credit. We see these as loans. And under 3827, they would be exempt from usury laws. There are no standard protections for consumers built into the bill as it stands. Providers are able to ding a consumer's bank account as much as they want. There are no caps on the fees that they can charge. There are even very extremely concerning data privacy practices with one of the most dominant EWA providers, Earnin. And so knowing that there are a lot of issues, knowing that this isn't a new industry, but we don't have a lot of data, if any, on how these products affect Texans. We don't want to see us jump the gambit here and implement a law where we already know that these companies are already acting in bad faith. And a lot of what I want to talk about too is that for today, if we did say that everyone was a good actor, that's not stopping them changing their practices tomorrow. That's not stopping bad actors coming in, realizing, oh, Texas doesn't cap these rates. We could offer anything that we want for consumers, and we know there's a market in the demand, and they'll pay it regardless. A lot of the different fees that we're seeing, from subscription charges to access the cash advantage portion, although they'll say you don't have to have a subscription, you do, to an expedited fee where we know that 90% of consumers use the expedited fee. People who are using these apps need money now. They're not able to wait. It's not just a day. The average we're seeing is 3 days to get these funds. There's also tips, which is a very interesting model and kind of a psychological mess up, essentially expecting consumers to tip for a service that they're already receiving. And we also see these tips set at defaults of 11, earnings default tip is $11 on a $100 advance, and it not being so clear that these are that these are optional, consumers are really confused. And I'm not just talking about theoretically. These types of products do target my age range. I'm a 25-year-old. I recently graduated college. A lot of my friends use these products. And so I've been able to walk through these products with them to see what their struggles are and what their concerns are. We know these are not a one-time product use. We know consumers continue to use these up to a minimum of even 36 times a year. So we just really have concerns with the current practices we're already seeing, and we are very, very nervous that if we pass this bill into law, it is just going to solidify those really bad practices. And so I'm happy to answer any questions. We also do have a legal expert here who will be providing testimony as well, because I'm not a lawyer, but happy to answer.
Thank you. Representative Leo Wilson.
Okay, when you say that includes no limits on the size of advances and no fee caps, it's still, why does there need to be a limit if it's your money that you already earned based on hours that you already put in? Tell me why you feel that there needs to be a limit on the advance, because it's their money anyway. And if the fees go up for using that, the person can decide, I don't want to do that this week. So explain that. And then it says permits multiple uncapped fees. You know, the previous testimony said it was like a $3 charge or whatever to use it. So, and then I have one more, but go ahead.
No, you're fine. Let me start with the first part. So our concern now isn't necessarily capping the amount, it's capping the fees. And I think there's a bit of misunderstanding with the direct-to-consumer model. These are not tied to your wages. Some of these products don't even do employment verification. They're looking for consistent income. And so there are true EWA providers that do go through payroll deduction, that do tie what they give you directly to your wages. A lot of these don't do that. And so I get what you're absolutely saying there, and there can be a conversation around that. But for people who are taking on $100 who may or may not even be working, we don't see that as being tied to their income. I know the average that we're seeing for these advances is about $80. And so the fees of a $3 expedite fee may seem small, but we're also talking about a subscription fee, an expedite fee, and a tip, and a very short amount of time. And so consumers aren't usually taking these out the first day they get paid and repaying them in 2 weeks. They're taking them out once they start to run out of money. And so when you're incorporating all of these fees into a very short turnaround, so let's say I take this advance out on Monday and my payday's Thursday, considering the timeline, the amount of the fees, and the size of the loan, there are major concerns that these are very high rates that
But
consumers are
that's
paying.
why people go to, like, you know, the quick pay places and
Right.
pay an even greater fee, is because they need money. They ran out of money. So I guess I just, so you want more regulations put in, and you don't think that the bill has enough regulation?
Yes, we do not feel like this bill implements standard consumer protections that we're seeing. So we don't have much data. I hate to say this, but the only data that we do have comes from California. And what they found was an average APR of 300% in the 300s. And I guess you also get into the discussion about, well, if this isn't a loan and we're saying it's just an extension, then we can't apply APRs. It essentially is up to the legislature to decide if we want to deem these advances as loans or if we just want to deem them as something else, which I'm not sure what that looks like. Either way, they need to be regulated in some way. We have major concerns, and this bill unfortunately doesn't address most of them.
But how can it be a loan if you've already, you know, earned those hours? You're basically paying a little bit of a charge to me to take out money that you already earned just 4 days early because you need it.
Yeah, I guess that's maybe we're not
Okay.
connecting in that way. So I'm sorry if I'm not being clear. For the models that are tied to your wages, that is a different conversation. These aren't, and not all of them are doing employee verification.
Okay.
So we don't believe that it's correct to say that all of these apps are tied to your wages, because that's not the case. I'm sorry if I wasn't as clear.
Okay, and so that the regulations are not enough to protect those bad apples that aren't linked to, you know, your employer and your your salary.
That's how we see it. I mean, there are also concerns with the employer based, but because most of the time it's through payroll deduction, there are more protections. This bill regulates both, and we do see different issues with both sectors. So yes.
Okay, and then what invasive data collection practices are being done?
Yeah, so we were just reviewing a couple of different privacy policies from these from these providers. So Earnin is one of the biggest EWA providers, and just sifting through their data privacy or their data privacy policy, because we do data privacy work at Texas Appleseed. We had a lot of concerns with the sale of personal data. So Earnin does disclose that they themselves do not sell data, but that they cannot confirm that for the third parties they work with, and we were already pretty concerned about that. And also for Earnin, they are a provider that actually do employ or verify your employment. In order to do that, they track when you go to work, so you do have to have the tracking feature available at all times. However, when you close the app, it also still continues to track you. So we were just concerned about why some of these practices were happening, and would love to know more and see if these actually make sense for the types of services they're offering. We're concerned with the bill being passed, they'll just continue to be able to do this without any insight or any research into why they're having these types of
But
policies.
that could be an amendment, correct, to help not have the invasive data collection?
That absolutely could be a conversation we'd like to have, yes.
The chair recognizes that Representative Van Dever is present. Representative Ryan, do you have a question?
Yes, I do.
Okay.
Well, I agree with the general line of questioning of Ms. Leah Wilson. I'm looking for the abuse here. I thought these loans were all tied to the payroll.
No, that is not correct.
Well, explain that.
Yeah, yes, sir. So the two models we have employer-based, where the employer will contract with the earned wage provider. So they'll contract with Earnin, or they'll contract with Daily Pay. You then have the direct-to-consumer, where I can download an app right now and get an advance. After I put in my information, I have to link my bank account, and then they determine if I qualify for an advance. Some of the concern that we're having is, even in the bill, the definition for earned wage access is a little ambiguous. So we're not even too sure if, for example, one of these apps, Clio, they'll offer you up to $75. They say explicitly they don't do employment verification. They'll just check for consistent income. For example, we know that there are people who have Social Security income that's coming in regularly, but we don't want that to be deemed as wages or employment hours. And so they are different models. They have their different sets of issues. There's an argument that the employer-based model is not a loan, since it's based off of your wages, and that's a conversation, but we do not feel that way about the direct-to-consumer.
Well, let's go back to the employment-based situation in which you're on the payroll, and apparently your employer's going to pay them the earned wage access, or whatever you call it. We're not going to call it a loan, I guess. What's the fee when that happens?
Well, it depends on the earned wage access provider. A lot of employers do cover those costs for their employees. It is up to them. They can be a cheaper option. And we
I was
also,
told it was $3.
maybe for Daily Pay, but there's a lot of different ones and they have different fees.
So how would you get it up to 300% or whatever you're?
So these numbers are based on tip-based models and fee-based models for direct-to-consumer through online mobile apps. These are not for employer-based models. They operate a bit differently, and so our concerns are not necessarily with those, but instead with direct-to-consumer, and this bill regulates both. And so we're thinking regulations just need to look differently, and there needs to be a separate conversation.
Okay, thank you.
Members, are there any other questions? Thank you. Appreciate it. The chair calls Corey Marshall.
Good afternoon.
Good afternoon. You are Corey Marshall. You are testifying on behalf of the Chamber of Progress, and you are testifying for the bill.
Yes, sir.
Correct.
That is correct.
Thank you.
Good afternoon, Mr. Chairman and distinguished members of the committee. My name is Corey Marshall, and I serve as a Director for State and Local Government Relations for the Central Region for the Chamber of Progress. Our corporate partners include some fintech companies, but our partners do not have a vote or a veto over our positions. You know, the opponents of this important piece of legislation will note that there are various companies that are doing various things, which is exactly why we need this bill to be in place. And I will make a personal note that I grew up in a low-income housing project to a hardworking mom, and I remember playing JFL Junior Football League football. I remember when my mom wanted to pay for football for my brothers and I, that she would be calling the family to borrow money, and she did work. And I would hear her say things like, "I get paid next week." When I was a junior in high school and I was a marching band nerd back then, my mom had to call family to try to find a way to pay for me to go to Disney World. And I would hear her say things like, "I get paid next week." I wish this type of legislation existed back then. We support HB 3827, a bill that will regulate earned wage access services that help workers bridge the gap until payday, something that could have been helpful for my family. This frees workers from dependency on the payroll cycle and alternative options like predatory lending practices. The proper regulation of EWA services can be of benefit to Texas, where the FINRA Foundation reports that 52% of Texans are living paycheck to paycheck. Customer research conducted by leading EWA providers in 2021 showed that this service is mostly used to pay bills on time, to buy groceries, and to avoid late fees. 8 out of 10 EWA consumers feel these services are the best available options to help manage their spending and say their life has significantly improved after using these services. Based on customer feedback to Earnin, a fintech company that provides on-demand access to already earned income, EWA is helping people make ends meet by providing a better alternative to them paying their bills or having to use credit cards with high annual percentage rates that could cause a backslide into debt. According to a study by Experian last year, the average credit card balance in Texas is $6,753, slightly above the national average of $6,194. Because EWA is not a credit product, nor does it extend credit to its customers, increased usage of these services by residents could lead to decreased credit card balances. In this post-COVID inflationary economy that we live in, the usage of EWA has increased across the country. From 2018 up until now, EWA services tripled in usage, primarily in response to consumers adapting to a financial environment where they have household expenses that cannot wait until payday. For single parents, like my mom, to the 9-to-5 worker, EWA has been and will continue to be a valuable option that works for their families and their budgets. We commend the authors of this legislation. We commend you, the distinguished legislators, for introducing this legislation, which puts guardrails around EWA by establishing clear regulations for service providers. We respectfully request for you to support HB 3827. Thank you.
Thank you. Members, do we have any questions? Thank you for your testimony. The chair calls Jenny Andrews. Afternoon. We show you registered as Jenny Andrews, behalf of the Texas Catholic Conference of Bishops, and you are testifying against the bill.
Correct.
Thank you.
Okay, I'll skip that first line, try not to repeat myself. I am testifying today in opposition to HB 3827 as introduced. We did receive a copy of the sub early this morning that I have not been able to fully evaluate, so my testimony will be related to the version that was introduced. And as I stated this morning, the Texas bishops support prioritizing the poor and vulnerable when addressing social and economic needs through public policy, which includes opposing usurious loans such as payday and auto title lending loans and certain cash advances. And we support setting reasonable limits on fees and interest rates whenever possible. Our perspective on this bill is informed by our service and ministry to the poor that I spoke about this morning. And we recognize that poor communities often have been underserved by traditional financial institutions and do need access to credit. And we can see the argument that earned wage access programs could be an alternative to predatory payday lending. However, we believe this would only be the case so long as there are considerable consumer protections explicitly written into the law. And we're not seeing these protections in the introduced version. For example, the bill exempt earned wage access providers from Texas usury statutes. Specifically, the section 398.003 states that the person registered under the new chapter would not be subject to the Title IV of the Finance Code, which contains the usury limitations under Texas law with regard to their earned wage access services. And additionally, the bill does not include limitations on the amount or frequency of fees and does not include minimum or maximum terms for the transactions. Having these kind of requirements would provide some basic parameters for the transaction and help to prevent consumer abuse. In short, there isn't anything in the bill that would prevent bad actors from the kind of terms that we're used to seeing with payday lenders, and this would be taking Texas in the opposite direction that we need to go. We have been working over the past decade to curtail high-cost lending abuses in support of human dignity and the common good. And we're concerned that without more explicit consumer protections in this area, this will become another venue for taking advantage of the poor in their time of need. For these reasons, we ask you to oppose HB 3827.
Members, any questions? Yeah, thank you for your
Thank you.
testimony. The chair calls Carla Sanchez Adams. Hello. I show you registered as Carla Sanchez Adams. You're speaking on behalf of the National Consumer Law Center, and you are against the bill.
That's correct. May I approach to hand out? So what I'm handing out, there are two pieces of paper. One of them has data from the California's Department of Financial Protection and Innovation, which is their regulators, and they have looked into 6 million transactions by these companies in California, and they have statistics here for you on the APR, on what's charged. So it's actual statistics on these types of products. The next page describes the earned wage advance products and what they do and how they're structured, and why we believe that they are loans. But forgive me because I didn't thank you for listening to my testimony or introduce myself. My name is Carla Sanchez Adams, and I am a Texan. I live here. I was born in Brownsville, Texas, and my family mostly still lives in the Valley and in San Antonio. And I was a legal services attorney at Texas Rio Grande Legal Aid for 13 years before joining NCLC last March. So when I give my testimony, I'm giving it on behalf of Texans, not from a national perspective, but also on behalf of Texans as well. So I want to answer some questions before going into my argument. And one question is, why is this a loan? A loan is an obligation to repay money. And laws make it very clear that you can't charge fees to collect your wages. So this isn't a collection of your wages. This is a loan to you that has to be repaid, that you're being charged a fee for. There are very few products that are actually earned wage advance products that are free. Those are usually paid for by employers, those that are free. Otherwise, they charge you a fee as the consumer, whether it's through the employer payroll deduction or whether it's through the bank's ACH when it's a direct-to-consumer advance. So there is a charge for it. And so it's not a wage, it's a loan, it's an obligation to repay. Yes, they're giving you access to money that your employer owes you early, but they're not paying you your wages. They're paying you a loan on your wages. So it is very comparable, in fact, to a payday loan because it's an advance ahead of payday. And the statistics here show that the APR actually ends up with the charges not just for the advance fee, the direct fee, but also for these voluntary tips, which aren't described as a fee in this bill. So I applaud the vice chairman for his desire to help Texans. And this product actually has a lot of promise, but the bill doesn't protect consumers because it creates a lot of loopholes in the law that don't protect consumers. One of those is by not having tips be included as a fee. Now, tips are supposed to be voluntary, but first of all, the word tip, when you hear the word tip, psychologically, it triggers you to give back, because when you go and you get served at a restaurant, you probably wouldn't stiff your waiter or your server because that would be rude. When you go pay for something at the checkout, you know that they're providing you a service, so you're going to tip. So psychologically, when you see a tip, and in most of these apps there's a default tip already entered in there, you're not going to say no. And if you do say no, it's very hard to actually undo it. There are studies that show, and I've tried this myself, that if you try to undo the default tip, they will turn off functionality of the app. They won't lend to you anymore. And so, this is, I see that you have questions. Do you want me to start? No, go ahead.
All right, so I have a question. So I see there's data from the California Department of Financial Protection and Innovation. So is this allowed in California?
Is this law?
Is this method of borrowing or giving out loans, is this legal in California?
It's treated as credit in California, and it's regulated as credit. There was a decision there's proposed rulemaking on it right now that would treat it as credit. There is an opinion in one of the letters from them on flex wage that says that particular model is not credit, but all the others would be treated.
So it's not considered credit in California?
It is.
It is considered credit in California, but they still allow these types of fees and tips in California?
They do not. So basically, this is what their finding is. Right now, they're proposing rules on how they would regulate it.
But if they're finding it, they have found it, which is present tense. So is this method of financing legal in California?
They say that they can't use it to evade usury laws, and that's what they're about to regulate. So they've had decisions, they've had investigations. They didn't have any rulemaking prior to the investigations to turn out how these products were working.
I think that is yes, it's still legal in California. So my question is, it's legal in California, which you would imagine it is or it isn't? I guess
The question is. The question is not whether it's legal. The question, because it's happening, the question is...
Okay, is this method that you're describing here in terms of what the APR is and the tips that you're talking about, is this done in California today?
Yes, and let me answer your question. The question that you asked me was if it's legal. Right now, even if you, under this regime, right, that we're creating with this bill, you can still lend to somebody money even though you're not licensed. And what's the ramification?
All right,
None.
I'm just trying to compare where your position is versus California's versus Texas.
Right.
Okay. All right, the second question is on the tip thing, which I don't understand, but essentially they will let you borrow money, and they call it a tip, whatever. If you decide that you don't want to give a tip, I think some people have the obligation to tip. Waiters, obviously. We're all getting tipped all the time. Everybody has their little tip jars out, and I think some people do and they don't. Someone lent me money and asked me for tip, I probably wouldn't put them in the classification as a waiter. But I think what you're saying is if I decide not to tip the person who gives me money, they what? They don't let me borrow any more money?
They can disable certain features of the...
But I'm assuming you guys don't want them lending people money anyway, so what's wrong with that? If
it's not that we don't want them lending money. I'm sorry. Let me make myself clear. I'm not saying these products are bad. I'm just saying that what the fintech, what they're trying to do is evade credit laws. And they shouldn't. They should be treated as credit. So just regulate them like credit. Right now you're regulating payday loans. You could regulate them the way you regulate payday loans now. You don't have to create a whole new different regime. This one is actually worse because there's no caps on any fees like there is with the payday model. And in the payday model, if you don't pay that first balloon payment, then you have to break it up over installments. You don't have that here. You don't have any private remedy here if it fails. If somebody lends you money as an earned wage advance and they're not licensed, you have no remedy as a consumer. It doesn't say that it's void.
That's fine. I guess I'm just trying to understand. Again, I've never heard of this model, but am I understanding it right? I'm not saying where I am on it, I guess. I'm just saying, but if someone advances me money, you want to call it a loan or credit or whatever, but if someone advances me money and then they're like, hey, I would really appreciate you if you gave me $5 or $2 or whatever, and then I don't, and then they say, okay, well, I'm not going to advance you any more money.
I mean, me personally, I'm like, well, the market's working itself out, right? Then you go into another lender who will lend you money, but they're regulated. And that's the whole point, is that those fees should be counted as fees, as interest, and be regulated as such.
But they're not
be
required, whereas, right? They're not required.
No, the fees are required. So that's the thing. If you are entering into a transaction to buy a car, right? If you're choosing to finance that transaction, you're going to be paying interest for the amount financed.
And I have to pay it.
Right.
Okay.
Here too. So if
You
you
don't have to pay this, though.
Yes, you do.
You said I don't have-
97% of these get repaid because they come straight out of your payroll or they come straight out of your bank account.
Do I have to pay this tip fee?
No, but again, not all of them use the tip model,
Okay.
but the tip should be a fee. It shouldn't be excluded from the fee. It should be counted as a fee, because if it's part of, if I'm paying you for a $100 advance, if I'm paying you $3 for the direct fee, if I'm paying you $5 for an expedited fee, and I'm paying you $3 for a tip, all of that is the cost of the product. That's the cost of what you're getting. You're paying all of that to get your money. That's a cost. That's a fee. Why isn't that a fee?
Because I don't have to pay it.
Maybe the tip, but everything else you do have to pay. And it effectively, if you are forced to pay because there's no way to undo that default tip, then it's not really voluntary.
I thought you said it was. All right. Anyway, I see Representative Bryant has a question.
Okay. Go ahead.
I agree that tip ought to be part of the charge. So let's assume that became, I guess we're not supposed to call it interest, but it's the cost of borrowing the money. All right. If that was done, what else would have to happen to this bill for you to believe it's good?
A cap on how much fees can actually be charged per $100 transactions, or whatever amount. I mean, whatever you guys want to settle on, but there should be a cap somewhere saying, like, this is the max, because currently, as one of my colleagues alluded to, currently some of these business models are not doing terrible things, but that doesn't mean that someone else can't come in the future and do terrible things, because the way the bill is written, it doesn't prevent them from charging $20 for $40 of an advance that you're taking out. There's nothing in here that would prohibit that.
Well, let me ask you a question. What's your understanding of the document that the consumer signs that wishes to access this?
So unfortunately, if you're talking about online or apps, there is no document, right? It's on a screen that you're seeing and you're scrolling through. And currently, I mean, here the disclosures that would be required, they say they can be either written or electronic. But again, you're talking about a screen on a smartphone. And also, it doesn't mention anything about language access or type or font. It doesn't mention if it's separate from the contract, before the contract, after the contract, where it is on the screen. So yes, it's necessary. Disclosures at a minimum are necessary, but they're not sufficient. So you need to be able to say, this is why earlier, I think Representative Ordaz was saying, you have those little boxes, that TILA disclosure that says, here's what you're borrowing, here's your APR, so and you can comparison shop. So if I'm a consumer who's like, I need money, I need to see how much this is going to cost me compared to what something else is going to cost me, I need to see that up front.
So does the document authorize you to get money from my employer?
So if it's a direct-to-consumer, then you are required to provide bank account information, and they will deposit to your bank account and they will take from your bank account as well. If it's through your employer, then there's a couple of models, it depends on how your employer pays you. So if your employer pays you through direct deposit, that would be that payroll deduction, that's how it would come in. If they pay you through a prepaid card or a payroll card, that's how the money would come in.
It's hard not to conceive this as a loan.
Correct.
So if we, let me just express my view of the matter. Working folks need to be able to access this money. Mm-hmm. And I want us to make that possible. And if it has to cost more because of it's risky, fine. I don't know how risky this is, since you get it out of the paycheck.
97% get repaid. That's a very low risk.
unlike the payday lender that came up here earlier and charges $1,000 for $1,000 in 6 months, at least he can say he has risk, right? So am I missing something? Is there risk that I'm not seeing here?
No, I mean, that's why the bill says they're not going to send it to collections. They're not going to report it. They're not going to call you because they get repaid 97% of the time. And they're making, again, the data that I showed you, $17 million is just on tips, right? That's not counting the money that they make from the expedited fees, which 90% of people choose to get the expedited fee. Because if you're getting an advance on your money, it's because you need it now. So you're going to ask for that expedited fee. That's where the money is made. And again, I'm not bashing the product. I'm not saying that it's worse than a payday loan. I think it's better than the payday loan, but it needs to be better regulated because there aren't any protections in this bill that say what's the max that they can charge. And also, the other problem that nobody's discussed is overdraft. So here, this bill says they can't charge you overdraft if it's an error. But if my payday is due the 15th, my mortgage is due the 15th, I have to buy groceries, I have to do all of these things. And then also this advance here is due the 15th, and I overdraft because my mortgage clears first or my other things clear first. There's nothing in this bill that says they can't charge my account tomorrow or the next day, or the next day, or charge it 6 times in one day and incur $35 of overdraft fee. So now I'm not only paying $20 on a $100 loan, but I'm paying $35 of overdraft day after day after day. And also, it is triggering me to have to borrow for my next paycheck ahead of time because I can't pay my bills from this week because I've already taken out money to pay for those bills.
Thank you. Thank you.
I will point out that 1.89% of auto loans are not being repaid, and they charge about 7%. So I don't think it's as easy, well, I know it's not as easy to say that 3% people don't pay. Obviously, auto loans are 7%, and they have collateral. Also point out, and maybe the author can speak to it a little bit about committee sub, which talks in great detail about having, per this, a way to set the tip to 0, and also making it clear the option to have a zero-cost method of doing that. But
I did read the bill substitute. The problem is that the way that it is written in the bill is problematic because it says it has to be in the terms of the contract, but how do you enforce it? There's no enforcement mechanism. The worst that could happen is that the commissioner decides that you're not complying and they take away your license. But me as a consumer, if you're charging me a tip or if you don't have a license and you're extending me this product, I have no remedy. And most of my clients as a legal aid attorney when I was there can't afford to file a lawsuit for $12, but that $12 could be the difference between eating and paying rent and being evicted because it's piling up over the course of 36 times a year. So think about that. It's $450 a month, which is, a year, which is huge to someone who makes $25,000 a year.
members, are there any other questions?
Thank you for your time.
Appreciate it. All right. The chair calls Ben LaRocco.
Thanks so much.
Hey, before you start, I show you registered as Ben LaRocco. You are here speaking on behalf of Earn In, and you are for the bill.
Yes. Thank you so much. Thank you, Chairman Capriglione, Vice Chairman Lambert, and members of the committee. Thanks for having me here today. My name is Ben LaRocco, Senior Director of Government Relations at Earn In, and testifying in support of HB 3827. Earn In is one of the largest earned wage access providers. We primarily work with consumers, but also have partnerships with large employers like Home Depot and Walgreens. Last year, about 150,000 Texans used Earn In, and about 350,000 have used Earn In historically since our company was founded about a decade ago. Last year, about 2 million Americans used Earn In to access their earnings. Once you have worked, you have earned that money. Those funds are legally yours, but your employer gets hold on to them till payday because running payroll is expensive. And we provide those access to those earnings without mandatory fees, interest, or recourse. You guys heard a lot about this. The bill requires that there's a free option. So about 20% of people that use our service don't pay anything for it. How do we make money? So we make money in two ways. Tips we just talked about them a little bit more. And the second is an expediting fee. So the base service uses an ACH transfer that takes generally 1 to 3 business days. Usually it's the next day. If you want that money immediately, you pay a fee of between $1.99, $3.99. The next is a voluntary tip. About half of transactions don't have a tip, and the average tip is $2. So people definitely know that they can change that tip if they want, that it's optional. There's a bunch of protections about disclosures and telling people that the tip is optional, and not, there was testimony that you can change the service if somebody doesn't tip. That's prohibited in the bill. So there's a lot of consumer protections that are in there around the tip. But many, and again, as I said, many people use this service for no cost whatsoever. Talking about data, so Earnin does not monetize on data in any way. There's no selling of data directly. To the best of my knowledge, no earned wage access company sells data. Financial data is regulated by the federal Gramm-Leach-Bliley Act. It's very strict. The Consumer Financial Protection Bureau, which is the main federal regulator, is also undergoing a years-long data rulemaking that's going to talk about this data. So consumer data is very protected. There's no money made on interest. There's no money made on late fees. All of these things are prohibited in the bill. So if somebody doesn't pay us back, that's completely our loss. We take the entire risk. So we are incentivized to ensure that it's a safe product, to ensure that our customers know what they're getting themselves into. Because again, if for some reason we advance somebody money that they can't pay back because they didn't earn it, that's our loss. Like, we take it. We don't send them to collections. So the incentive is for us to do the right thing on that. There's a lot of good guardrails in this bill. I can answer questions. I also can answer some of the questions that are already asked. I don't know, Chairman, if you guys have a preference, happy to answer some of these questions that were asked earlier.
Well, I just want to ask, just so we can,
Sure.
I guess, make sure. So
Yep.
you said that 20% of your customers pay nothing,
Yeah.
zero.
Yes.
Okay. And is it accurate that almost everybody, 97%, pay back within 10 days? Or,
Yeah, it's somewhere in that neighborhood, maybe a little bit lower than that.
all right, and the average fee that is charged is $1 to $2.
Yeah, so we're on an average transaction between the expedited fee and a voluntary tip, we're at about $4 to $5 per transaction.
Okay, $4 to $5
Total.
transaction. And what is the average transaction size?
It's like $85.
Okay. So someone needs $85 for a couple of weeks to do whatever, get gas to go to work or whatever it is that they need.
Correct.
They don't have to pay necessarily, but if they think they might use the service in the future, they will, right? And maybe it's $4 or $5 for them to borrow $85.
Correct.
And the bill does say that there has to be a method by which they don't pay. And
Correct.
You can't set it to $1 to $2. There must be, according to the law that we're having, that you have to be able to set it to zero.
Correct.
Right.
Yeah, and there's specific
Yeah.
transparency and disclosure language in there that says, you have to tell people that it can be zero. There has to be clear language that states how people can access that option.
Okay. Do you have a question? Representative Bryan.
How is it that when it happens, that you don't get repaid? How does that happen?
Yeah, so there's a few different ways that can happen. So there's two different ways that we get paid back. One is an ACH transaction. This would be similar to the way that you pay your utility bill or Netflix or anything else. It's the same, is that we're governed by the same, it's called the Electronic Funds Transfer Act. It's a federal act that shows how you can debit a bank account. It's just the same as all others. So somebody can revoke that. They can say, hey, I know I was supposed to pay you back on Friday, but the rent's due, so I can't pay you back. They send us an email that says, hey, don't charge my bank account. We don't charge it. That's one thing that happens. They also they can have no money in the account. If they just spend all the money, there's no money in the account. They put their paycheck into a different account, or they don't cash it in their account, and there's nothing in there. We can't go after that. They might get charged an overdraft fee in that case. That goes to the bank. We have no control over overdraft fees. There is, of course, language in here that if we cause an overdraft fee, that's our fault, that we would reimburse that, which is, that doesn't happen to anywhere in law, that the company has to reimburse the overdraft fee.
What's your repayment rate?
It's somewhere in the high 90s. I don't know the exact number, but it's that 97% that the chairman mentioned is probably somewhat close.
mean, wouldn't you agree it's pretty much a risk-free industry?
I mean,
local banking.
no, I definitely would not think that it's risk-free. I mean, we are advancing our funds to folks that then they can choose not to pay us back, that are the equivalent of their wages. There's certainly risk involved in that.
Yeah. Without any, without the law applying to you with regard to interest rates, you can require about as much as you want to, can't you?
You cannot require anything, right? You can have people opt into services that they voluntarily opt into, but the bill says you cannot require any payment whatsoever. So,
Well, wait a minute. If I access your services,
Yeah.
you tell me ahead of time how much it's going to cost me, don't you?
yeah, which is zero as the base price. And if you want to opt into services, so like the base ACH transfer is free, and if you want to get that money immediately using debit, you can opt into that, and the price is $1.99 to $3.99. That's not required to choose that option, but it's an option. And the same with tips. You can choose to pay a tip. Some people do, many people don't. But there's no required fees. And the required fees are banned in the bill.
Oh, well, so I want $100.
Yeah.
What's that cost me?
It could cost you $0. It could cost you $5 or $10.
Well, I'm for zero, so how
Yeah.
do I get zero?
So you download the app, you connect your bank account, you choose $0 as a tip option, and you don't choose the expedited fee, and you get that $100 for $0.
Over and over and over?
Over and over and over.
So how-
Many people that use our service never pay a dime for it, ever.
How do you make money?
The two ways we make money are what I just talked about: the expedited fee and the tip. There's no interest, there's no late fees. We don't monetize on any other way. It's only those. Those are the only ways we make money.
So leaving out the tips, for you to make money, I have to want to get my money faster than you would otherwise provide it. Is that correct?
You have to be so delighted with our service that you voluntarily choose a premium service or choose to reward us with a tip, because our incentives are aligned.
Premium service meaning get it faster.
Correct.
And what is not getting it faster? How fast?
So ACH is usually 1 to 3 business days. That's every financial institution uses ACH. We don't control the speed of that.
So that's normal.
That's normal.
I get it free in 3 days.
Correct.
I want-
Usually the next business day.
Your business model is you just get paid because the people want it right away the next day.
They want it. So the next day is free. Immediately has the fee. So by the time you walk from here to the door, it's in your account. That's the fee of $199 to $399.
Okay.
And there's no collections, no anything. So you asked earlier about the $1,000, how much it costs. On average, we make about 4 or 5%. So that'd be $100, $80 on $1,000. So you're talking about a 90% reduction in cost to the average consumer compared to what they might be paying now on a pay loan for us.
Thank you.
Sure.
Members, any other questions? Representative Shawnee.
Thank you, Chairman. Does this bill allow you to increase the expedite fee in the future?
Yeah, so it does not set a fee cap on the expedited fee. Different companies have different fees. I think one thing that I think is important based on the free option is that provides an important competition. So if for some reason we were going to jack that fee up to $20, people could just wait $1 or wait a day if they thought that $20 was too much. So having the free option provides an important competitive way to keep that cost low.
And this free option is mandated?
Mandated in the bill, yes.
Got it. Okay. All right. Thank you.
Sure.
Members, any other questions? All right. Thank you, sir.
Thank you.
Is there anyone else who wishes to testify on, for, or against House Bill 3827? If not, the Chair recognizes Vice Chair Lambert to close on the bill.
Thank you, Mr. Chairman, and thank you, committee members. I know conceptually it's a difficult thing to kind of comprehend and get your arms around and hands, but let me just say that the reason we need this legislation and the reason the industry is wanting guardrails is because it is unregulated at this time in the state of Texas, and yet we have businesses operating very successfully here. I think the number was mentioned about 150,000 Texans with one company. I'm sure that number escalates fairly significantly when you talk about the other businesses that are operating here. I mean, how many times do we see companies coming to us saying, "Please regulate us. We want regulation," because of the simple fact that we have good actors and we have bad actors, and we know that that's true in many businesses, and that's why we set laws, and that's why we establish regulations, and then allow for those that are administered with the task of being the regulator, the chief regulator, to set rules and to decide what that rulemaking looks like. I want to just answer 2 or 3 questions that I think continue to be a little bit conceptually misunderstood. Why are these companies exempted from Title III, Chapter 151, and Title IV, which is our finance code? As a new technology, earned wage access does not easily fit into existing regulatory buckets, but has qualities similar to payroll processors or money transmitters. Rather than trying to force this service into an existing bucket that it does not fit, we created a new bucket in this legislation in Title V to regulate this service based on the specific risk to consumers. And we further clarified that other provisions do apply, so it is not subject to multiple contradictory regulations simultaneously. Well, another question, why do we need regulations when these companies are already operating? Well, earned wage access companies are operating, but it would benefit both providers and consumers to have industry standards for consumer protection and provider accountability. This way, bad actors can't enter through the back door, and providers will have clarity to continue growing and innovating responsibly. Why is this not payday lending? The terms are completely different. The burden of cost is on the providers, not the customers. No mandatory fees, no interest, non-recourse. Customers have the right to revoke their authorization to subtract funds or withdraw funds. We made very clear that this is not an extension of credit. The definition of lending in the finance code is very specific, and we made sure that the language in this bill does not contradict Title III or Title IV. So again, this is a service that's being provided, and I think that we need to make sure we have guardrails. And so with that, Mr. Chairman, I would respectfully close.
Thank you, Vice Chair Lambert. The committee substitute is withdrawn. If there is no objection, the bill will be left pending. Is there any objection? Chair hears none. The bill is left pending. Chair lays out House Bill 4219 and recognizes Vice Chair Lambert to explain the bill. The chair offers a committee substitute.
Thank you, Mr. Chairman and members. Appreciate the opportunity to lay out House Bill 4219 relating to increasing the interest rate of certain consumer loans. In 2003, the Texas legislature adjusted the blended rate structure associated with credit provided by Texas lenders regulated in accordance with Chapter 342, Subchapter E of the Texas Finance Code. While economic conditions over the past 20 years have generally been stable, recent record levels of inflation are increasing many Texans' need for access to safe and affordable credit. At the same time, the federal government has sought to tackle high rates of inflation by raising interest rates. The federal funds rate, the overnight lending rate that banks charge other financial institutions on an uncollateralized basis, has increased along with interest rates. The Fed funds rate is directly related to the cost that Texas lenders must pay to secure funding from banks and the capital market to lend to their customers. Because the cost of money has increased, credit availability has tightened, and about 3 out of 4 Texans who seek loans from Chapter 342, Subchapter E lenders are being turned away. Those unable to get a loan from lenders regulated under Chapter 342, Subchapter E still need credit and are being pushed into unregulated loans and higher cost alternatives. House Bill 4219 would increase the credit available to Texas borrowers from regulated lenders by more closely aligning existing statutory rate caps to the cost of obtaining funds as reflected by the federal funds rate. This legislation would also authorize the Consumer Credit Commissioner to publish a rate directly tied to the federal funds rate with a maximum not to exceed 5% that could be utilized by lenders regulated under the Texas Finance Code. This methodology would account for fluctuations in the cost of funds while maintaining the rate structure deemed appropriate by policymakers, thereby making regulated credit available to a much larger population of Texans. The committee sub simply updates language to preferred legislative counsel There are witnesses here to testify on this bill and answer any questions the committee might have. I'm happy to answer any questions. Reserve the right to close.
Thank you, Vice Chair. Members, any questions? Okay, thank you, Vice Chair Lambert. No further questions. We'll proceed to testimony. Chair calls Daniel Garza, representing One Main Texas Consumer Credit Coalition, for the bill. Is that correct?
Yes, sir.
Thank you.
Hi, good afternoon. Hello, Chairman, Vice Chairman Lambert, and committee members. My name is Danny Garza. I'm here today representing One Main Financial and the Texas Consumer Credit Coalition in support of the committee's substitute for House Bill 4219. I'm here as a constituent of Chairman Capriglione as well. To give you a little background, I serve as the Senior Managing Director for One Main Financial. I'm responsible for overseeing the One Main's branch network from Texas up to Minnesota and everything west of each state, all the states west. I have worked for One Main for 30 years. I grew up in the business, and I'm very proud of the work that we do and the customers we serve. For decades, One Main has provided safe and affordable credit options to Texans under Chapter 342, Subchapter E of the Texas Finance Code. One Main has 116 bricks and mortar locations in Texas and serves more than 210,000 Texas customers. Further, the TCC has branch locations in every committee member's district. Statewide, the coalition serves more than 1 million Texans, many whom are your constituents. At One Main, our model is rather simple. Our business is successful when our customers are successful. For this reason, our installment loans, which are subject to strict underwriting requirements, contain fixed interest rates, fixed terms, and fully amortizing payments that support household budget management. We work with our customers to assess their ability to repay and ensure that they receive the loans that they need with payments that are manageable. We also report to major credit bureaus to help customers build their credit. The members of the TCC operate primarily from a bricks and mortar branch networks in local communities around the state, supporting those communities with tax revenue, jobs, and lending capital for consumers. In our Texas branches, we have seen firsthand how inflation is cutting into Texas spending power. Bills are harder to pay, unexpected expenses are harder to meet, and saving for a rainy day is more difficult. In times like this, many Texans have increased the needs to access responsible and reliable credit. TCC members are uniquely positioned to help, especially the Texans that may have less than perfect credit scores. However, like consumers, we are feeling the inflationary pinch in our lending power. Chapter 342E rates have not been modernized since 2001. Since then, our cost of doing business has increased dramatically, such as rent, employee wages, and healthcare costs. On top of this, recent repeated increases in interest rates set by the Federal Reserve, the federal funds rate, have made accessing capital that we need to lend consumers extremely challenging and costly, often leaving Chapter 342E lenders with fewer dollars to loan to Texans, which leads to borrowing seeking higher cost alternatives. To reverse this trend, HB 4219 ties the interest rate of Chapter 342E loans to the increases and decreases in the federal funds rate. The legislation includes a maximum ceiling of 5%, no matter how high inflation may go. This bill is carefully drafted and truly responds to the inflationary pressures. The proposed change will go a long way to promote the beneficial alignment of interest between borrowers and lenders in expanding homegrown credit options for Texans. I thank you, Mr. Chairman and Vice Chairman Lambert, for bringing this bill forward. Mr. Chairman and members of the committee, thank you for your time today. I'm happy to answer any questions you may have.
Okay, thank you, Mr. Garza. Members, are any questions? Okay, thank you.
Thank you.
Okay, Chair calls Brianna Gordley with Texas Appleseed on the bill. Okay, am I correct?
On the bill. Ooh,
On the bill?
yes.
Okay. Texas Appleseed on the bill.
Yes, we are on the bill. We do have a variety of views on different things.
Thank you.
Committee members, thank you so much. My name is Brianna Gordley. I work for our Fair Financial Services Project at Texas Appleseed, and I am here to quickly testify on House Bill 4219. While we don't like to see interest rate increases, we're not opposed to seeing justified and reasonable rate increases, and that's how we view House Bill 4217. We see this bill as a middle ground for consumer protection advocates and lenders, providing just a bit more flexibility for finance companies licensed under Chapter 342E of the Finance Code.
Ms. Cordley, I think you corrected 4217.
Oh, is it?
And the bill is 4219. Just wanted to be sure that.
Oh my goodness,
you understand that.
4219.
Thank
I'm
you.
sorry. I'm so sorry. To finish, yes, Chapter 342 e-loans are one of the more affordable loan options available compared to other loans in our state, and so we do feel that this bill is justifiable to the rising costs of the market.
Thank you. Members, any questions? Thank you for your testimony.
Thank you.
Is there anyone else who wishes to testify on, for, or against House Bill 4219? If not, the Chair recognizes Vice Chair Lambert to close the bill.
Thank you, Mr. Chairman. Again, more Texans needing more access. This modernizes and brings up to date rates that have been in place for almost 22 years. So I think it's necessary, and appreciate your favorable consideration, and I close.
Thank you. Committee substitute is withdrawn. And if there's no objection, the bill will be left pending. Any objection? Chair hears none. The bill is left pending. Okay, the Chair lays out House Bill 3670 and recognizes Representative Plisa to explain the bill. The Chair offers a committee substitute.
Thank you, Chairman, Vice Chair, and members of this esteemed committee. I am honored to have the pleasure of serving alongside of each of you and excited to lay out House Bill 3670 before you today. Private activity bonds are a critical financing tool for commercial rental housing projects throughout the state. The interest of these bonds is exempt from federal income taxation, which allows lenders to offer a lower interest rate. Texas is the only state that requires full funding of private activity bonds at closing rather than a partial funding as needed during construction. In a typical construction project, a conventional loan would be drawn down as needed to pay contractors for the work that they have completed and suppliers for the materials that they've supplied. Partial funding of private activity bonds is allowed in other states because interest is paid only on the amount funded, thereby making the loan less costly and more efficient, allowing more of the bond proceeds to be used for actual construction costs. In Texas, the definition of closing currently requires full payment of the bond. House Bill 3670 defines closing as delivery of a bond in exchange for payment that may include partial payment and incremental funding, provided that no less than 10% of the required payment must be funded at the time of closing. This definition will align Texas with other states in allowing partial funding of private activity bonds and reduce unnecessary interest expenses while protecting lenders. Borrowers will benefit from lower interest rates, which will allow more bond proceeds to be utilized for construction costs rather than financing costs. This will be a benefit for Texas because more housing infrastructure will be generated with the interest savings to accommodate the state's growing population. Members, I'm happy to share that there is zero opposition to this bill and zero fiscal impact to the state, a positive fiscal impact to private activity bond borrowers and developers. Last session, this bill was previously filed by former State Representative Scott Sanford and was voted out of this committee unanimously and in the House and Senate. It was passed on local and consent. Unfortunately, it ran out of time. Representative Frazier and I represents part of former Representative Sanford's old district, and I am grateful to Representative Sanford for starting this work, with Representative Frazier for joint authoring this bill, Representative Bryan and Vice Chair Lambert as well for being my joint authors on this bill. We have some expert witnesses here, and with that, I reserve my right to close.
Okay, thank you. Members, any questions? Okay, if there are further questions, we'll proceed to the testimony. Chair calls, Samson Babalola, testifying for self and ITEX Group, and you are testifying for the bill. Is that correct?
Yes, sir.
Thank you.
Good afternoon, Chairman and Vice Chairman and members of the committee. My name is Samson Babalola. I am a development director for the ITEX Group, which is a affordable housing development company based in Port Arthur, but also has an office in Houston, Texas. I'm speaking in support of House Bill 3670. ITEX specializes in the development of affordable housing. In any given year, we can have about 5 to 7 projects that are going through the development pipeline to get to a closing. When it comes to utilizing bond financing in the development of affordable housing, the state of Texas, as the representative already mentioned, requires that you draw down 100% of the bonds at closing. And so this is an issue typically because bond allocations are around 20, 40 million for these affordable housing developments. And so at closing, if I have a deal where I got an allocation of 30 million, from day one at closing, I'm paying interest on 30 million, even though I don't need all that money at that time. So House Bill 3670, as you all already know, seeks to change that requirement so that we can only draw down essentially what is needed, no less than 10%. This will reduce the amount of interest paid during construction period and also reduce overall financing fees and overall project costs. Thank you for the time and opportunity. Take any questions.
Thank you, sir. Members, any questions? Thank you for your testimony.
Thank you.
Chairman calls Bobkin Simonians.
This afternoon is a difficult name.
Yes. Thank you, Mr. Simonians. I have you testifying for yourself, and you are for the bill. Is that correct?
That's correct.
Thank you, sir. Proceed.
Mr. Chairman, members of committee, thank you for this opportunity to be here. I was here last year as well and testified for changing the rule, as Texas is the only state in the country, as mentioned earlier, that forces developers to issue the bond for the full amount, pay interest for the full amount, even though it takes about 12 months to 24 months to spend the money. Let's take an example of a $20 million project at a 5% rate of interest. The change that we are proposing here, or you're proposing here, is going to save the development about $500,000 to $800,000. At a time where the construction cost has increased, at the time that the interest rates have gone up, this is a welcome opportunity to promote affordable housing. Otherwise, we are going to be in constraint to meet the budget and develop new affordable housing projects. So I'm speaking in full support of 3670. It's long overdue, and it would help the state to provide more affordable housing that is so badly needed. Thank you for your time.
Thank you, sir. Members, are there any questions? Thank you, sir. Is there anyone else who wishes to testify on, for, or against House Bill 3670? If not, the chair recognizes Representative Plesa to close on the bill.
Thank you, Chairman and Vice Chair and members, for considering this important legislation that will benefit all of our districts and all the industry partners involved with these important projects. As I mentioned, this bill was sent to local and consent calendar unanimously last session, and I ask that you favorably consider this legislation and send it to local and consent this session. And with that, I close.
Thank you, Representative Plesa. The committee substitute is withdrawn. There is no If there is no objection, the bill will be left pending. Is there objection? Chair hears none. The bill is left pending. Okay, members, that concludes today's agenda. Is there any further business for the committee to address? If not, the chair moves to adjourn. Is there any objection? Hearing none, the committee stands adjourned, subject to the call of the chair.